Well, Bob, it's funny. Everybody thinks about gold when they think about inflation. Gold actually GLD had net redemptions of almost $9 billion this year. It's all about spreading into areas like energy, which was a huge surprise. We also saw agriculture, base metals. So some of those diversified ETFs in those areas did very, very well. It was very, very surprising that we saw bonds not do so well. Tips, on the other hand, brought in a record $35 billion. So again, going forward into 22, I think we're going to see more of the same. The big message to investors, Bob, is inflation and rising interest rates does not do well for your bond portfolio. And we've got hundreds of billions of dollars that's tied to the Barclays Agg, and that index is going to suffer as we continue to see higher interest rates.
So what about the stock market? Is the tech domination finally over? We've had 13 years of technology and growth stocks outperforming value stocks like energy and banks and pharmaceuticals. Is that long domination finally starting to end?
Well, the good thing, it diversified. The S&P 500 did well, but the equal weight S&P 500 did just as well as the SPY, for example, or the QQQs. And as you said, value, large cap value, almost did as well as that group too. So going forward from a valuation standpoint, that says a lot for stocks going into next year. Cyclicals are something that we're going to keep a watch on. But as you point out, the Cathie Wood innovation, disruptive, thematic strategies took it on the chin a bit. But from a long-term standpoint, I'm not sure if I'd bet against them. And one other area, online buying, and also China, were clearly in the red. The question is, will they end up turning around as we go into 22, as they've had some major corrections?